Hello. So, if I showed you three trading segments, one had a success rate of 68%, one 42%, and one closed positions within 12 days, which one would you choose? Now, let me show you the data. Now, most traders would answer that question incorrectly. They would focus on the one single metric instead of understanding the structure underneath trading performance. At first glance of this table, most people would immediately select segment A. It has the highest success rate of around 70%. Therefore, this is more comfortable psychologically and provides positive reinforcement over time, and also confidence is maintained too. However, despite the high success rate, expectancy is actually the lowest in comparison to the other two. Therefore, this highlights that success doesn't always equal the greatest value over time. Now, in comparison, looking at segment B, it has a good success rate of 42%, but many traders would reject this in comparison to segment A. However, when it is successful, it provides more substantial value in comparison to segment A. This is because it has the highest expectancy of the three. Therefore, long-term performance may be far more superior. So finally, looking at segment C, it kind of sits in between the other two. Its success rate is reasonable, its expectancy is respectable too. However, the interesting characteristic is the average holding time to reach profit targets. So this highlights that capital is recycled much faster compared to the other two, and it's therefore more flexible and efficient as well. Therefore, the mistake is assuming that one single metric, tells the whole story, then optimizing for success rate or expectancy or even speed. However, trading performance is usually an interaction between all of those three. Therefore, this highlights the importance of structural analysis. Instead of asking which segment has the highest success rate, a more useful question may be which segment provides the best value. Then, beyond that, which is most stable or consistent across different market conditions. Over time, this should start to reveal where actual market edge exists. You see, I started to become interested in analysing trading systems at a structural level. Beyond looking at the headline statistics of success rate, I wanted to understand where expectancy exists, where it deteriorates, and how performance changes across different market conditions. Then I found that identifying those relationships was actually more valuable than success rate alone. So, if you'd like to learn more about trading expectancy, uh, structural analysis, or systematic trading behaviour, I provide additional information in the description below. Thanks for watching today, and I'll see you in the next video. Bye for now.